the book right now. But if anybody wants a really crazy read about trading and a system, just let me know. Zap me a DM, and I'll send you a P. His own sort of take on the market cycle, right? It's not like the market maker cycle method, but it's very similar because he really talks about like 3 to 5 day cycles of ups and then downs, right? So again, if you want the book, just
Yes,
zap me a DM and I will send it to you. All right.
yes.
Um,
Right.
so one of the greatest things that he came up with was called the Taylor zone or the Taylor range. All right, and actually on the Nasdaq on Friday, that was the Taylor range. All right, so that I figured it would be a decent time to talk about this. Um, so I'm going to try to keep this as basic as possible, but we'll just kind of we'll glance over the mathematics of it so you guys can understand just how crazy it is. And it's one of those wild things because when you see a guy come up with a system like this, it's like would you even contemplate this? Like how does this come into your mind, right? Pretty wild stuff. So it is a basically a system that is going to create for you zones, all right? They call them envelopes. So there would be a support or a buy envelope, and there would be a sell or a resistance envelope. That's based on the last 3 days candles. Uh, and then combining that with his theory on the market cycles, there is a buy day, there's a short day, there's sort of like a fade day. There's all kinds of different ways you can trade this, all right? So again, like I always say, when you're looking at this stuff, all right, you must rely on your own judgment, right? Nobody else's. So you got to take this stuff, look at what makes sense to you, apply it where you can, and discard the rest, and don't use it. If it doesn't make any sense to you, don't use it at all, right? Um, as the monster trader Linda Rasch says, listening to others will not give you an edge, but rather will serve as a distraction. All right. Because if you're trying to find your edge, that is what your mission is, right? It's not find somebody else's edge. Okay. So, having said that, basically, what you're going to do, uh, this is going to sound a little bit crazy. Okay. So, for the buy envelope, all right, as soon as the day closes, for the next day, you're going to start doing your calculations. All right. So, your first uh, support zone is called the decline number, right? So the decline number should be somewhere below or right around the close. And I'll just give you a quick flavor of how this would be calculated. You are going to take, oh, the, okay, you're going to take yesterday's high, all right? So the previous day's high, right? You're going to take away today's closing, so today's low, okay? And then you're going to subtract that number from today's high, and that would give you the decline line, okay? Kind of crazy. To get the next one is called the buying under number or the buying under line, all right? And you would calculate stuff based on different things, all right? But what you have to do is you have to take this calculation for the last 3 days, right? So in effect, if you were looking for the decline number, what you would have to do is uh, take this high, all right, subtract it from the low of today, and then you would want to take the high of this day, subtract it from the low of this day, and then you take the high of this day and you subtract it from the low of this day. Then you divide that by 3, and that would be your number, right? But after you do all of those subtractions, then you also have to add the high, right? So it gets really weird, and you're going to be doing this for multiple calculations, all right? So it's pretty wild, and it's kind of cool. I think it is to kind of get into it and do your own calculations, but it is time consuming, right? So at the market close, you would want to do that. All right. Now, there is a school of thought that says that when you are trading NASDAQ futures, all right, and this is pretty it's pretty big in the futures world, all right. You do not do your calculations based on the futures market. You actually go to the NDQ, right? So the NDQ trades for much less time, right? So figure out the time that the NDQ trades, and that's the time frame you're going to be looking at to do it on the NQ1. So you're actually going to have to go down to the 1 hour time frame and do these calculations on the 1 hour time frame using the actual NQ1 market hours. All right. So don't get the NDQ. Sorry. So I know this is already getting complicated. So we're gonna stop with the complications, and we're gonna get this simplified real quick. All right. So let's take this down to the 1 minute. All right. Now the weird thing is that once you create your zone, not the weird thing, the beautiful thing about this is once you create your zone, let's say you've got your zone set up and you know, you've got your levels in here, all right? So every day you're going to have 5 different levels, all right? Because there's something called the pivot, and the pivot is based on market direction. So if you're in a bullish market phase, they're going to be printing out pivot points for you to turn back around, right? So the pivot point would generally be much higher, right? Uh, if the market opens and starts just dropping, so let's, I know this is kind of wacky, but this is the best way I can explain this. If the market was to open here and it just starts going straight down and it eats through all of these levels, right? What you want to do is have a range, all right? Because it is a zone, which makes it a range. And then you would take this and you would place it on the actual high of the day, and it'll give you that low there, all right? And that's what you would be sort of looking for, somewhere there or somewhere within that envelope level, all right? But you would take this envelope level, obviously. Oh, did not want to do that. Take this envelope level and move it all the way down to the bottom, all right? So this will give you your zone to turn back around. Now, if it then turns around and starts moving back up, then you would take your zone and you would put it to the bottom of the day so far. So let's say price did something like this, right? And then you would move that zone up high to then try to find the top for the day, or somewhere, oops, I did it again, or somewhere in this selling envelope, all right? So that's what they call The zones that you'll create on the top and the bottom, they refer to them as envelopes. And then this whole thing is the Taylor zone, all right, or the Taylor trading range. So instead of having to do all these calculations, and if anybody wants as well, just zap me a DM and I will send you, or actually I'll post it. I'll post the calculations, how to calculate this stuff on, I guess I'll do it on the main channel. Main chat, I'll do it. All right. And if you feel that is something that you're kind of into, go for it. If not, no worries, because you can come to your indicators. Actually, hold on. Okay. And here's your indicators called the Taylor True Ranges. All right. It's actually, hold on a second. All right. Taylor True Ranges Deviations by Virel 8. All right. So save that in your favorites if you want. Now it's a bit weird using this. You're going to have to get used to a couple of different things here. All right. So this is where you would be looking for the pivot. All right. This is your pivot line. This is your envelope and your envelope. All right. So tomorrow you really want to kind of watch out for these zones, right? But the most important thing is when the market actually opens, you want to see how it behaves, because you don't just want to take this thing at face value, right? So again, we mark out the high, mark out that low. That's going to be the range. And then because we are putting in some bearish market structure, this would be the point that we're looking to turn around on, all right? And oddly enough, not oddly enough, but if we look at the 1 hour, the 1 hour chart on the NQ1, we are right now on the 100 EMA, and we've just kind of broke below it. If we look at this level here, we're at around 20,036. Don't know if we'll get down there, but this says we might. That's 1949, 19,949. Sorry. All right, so that might be the point where we start to turn around, right? But again, you're going to have to be moving this stuff around quite a bit. So if the market just starts to breaks up and starts breaking high after high after high, just move this whole zone up to the open of the market and look for any possibilities up there. All right. Does this make sense? Mm. All right. So when the market opens, what you're going to see is that these are pretty dynamic. That this level is not going to stay here. So it depends how the market moves on this indicator. Okay. That's why I prefer to kind of do my own calculations on it. But if you do want to use this indicator, it's definitely quite useful. All right. You can notice here that this, see that low? I mean, it's very close to that envelope there. And in fact, the calculations I did, it was right on it. So this is going to be our zone that we're going to be looking to trade, right? So if price comes down into this envelope here and starts to turn around, that's a good signal that we're then going to come up and potentially test the top of this envelope, all right? So the Taylor True Range, okay? Now, once you load this up, there's one weird thing about this indicator is that there's really not much that you can change in terms of settings. There's nothing you can really do. The daily look back is 4, which that's what it has to be for you to do your calculations, all right? And then the text sizes, this is the only thing I changed because they come in tiny, which I was like, what the hell does that say? Try to amplify that, but I really couldn't. So that's the only thing that I was able to change, was from tiny to small. If you put it on normal, this all disappears for some reason. So Yeah, a bit of a strange indicator in that sense. But this is what we're lining up here so far. So this is your again your sell envelope, and this again is your support envelope or your buy envelope, all right? And then this would be our mega pivot point. All right, so today we're looking like we're, going to trade within this range. That's hopefully what happens, but it's not necessarily that straightforward, right? Okay, so does this mean when price comes in here, you just start longing, like no, you do not. You want to see again some sort of reason why you would want to take a long, whether that be EMAs, price actions, uh, market structure, wait for some new highs or higher high and a higher low to be put in, and then look to get in on a trade that way. Depends how aggressive you are, right? Possible to rewind one day and show it live with a bar replay. We can do it. I'm not sure if this will work. All right, so there we go. Let me just make sure that this is not messing around here. Nope, that is different. All right, good. Yeah, I think it is working. So let me just mark out here the open. All right, so you see it starts dumping and this box moves right down. All right, and that's it's pretty wild. So all of a sudden we are in the buying envelope and we are looking to trade this up, all right? Uh, could still potentially dump all the way down to here. So one thing that we'll talk about it briefly is the market cycle. Uh, but we're going to kind of get more into the indicator today than we or the concept of the indicator than we will into the whole system that Taylor used. All right. So here we go. We get our open, get a little peak up, and then price starts dumping. So you see it's a pretty dynamic thing here. It starts moving all around on you, all right? And that's because right now we are using the 1 minute chart, right? So it's going to move around. So when you plot this stuff out, let's just rewind this a little bit here. Hit. Ah, did not want to do that. So you plot out the envelope. You plot out the envelope. And you plot out the range. All right, so that once this stuff starts moving around, you can actually get in there and do stuff with the actual big range, all right? So there it goes. It starts moving. And at this point, like honestly, you really don't want to use it. So this is the kind of stuff that I like to start looking at the London Open. I mean, I'm asleep for Asia anyways. So now once it's come up here, you can start to look to move this whole range up. All right. But personally, I do not do that. I wait for pullbacks. All right. If I was trading Asia. All right. Now let's just check out this selector here. See when it dumps how weird it gets? All the way down there. And then as soon as it turns around, it pulls all of that envelope back up here. And now we've got 6 lines here. 2, 3, 4, 5, 6. So this is very weird. It'll even like it's a bit of a wacky indicator. So take your time with this. Get used to watching it. Don't start trading this. This is not the kind of thing that is going to make you money if you just start trading it. It's not going to happen. So that came very close to hitting into this little envelope, but didn't. Should have probably done this on a higher time frame, but let's stick to it. Okay, so real quick here, you see this did hit into the envelope here and then turned, right? So this stuff is tradable as a dynamic sort of zone, all right? But for goodness sakes, use Confluence. So you could be using it with EMAs, uh, whatever else, fibs, order blocks, fair value gaps, that sort of stuff. It's just more Confluence in that nature, all right? But the best way to look at this thing as is as a almost like an ATR sort of indicator, right? All right, so now as you start to break below and it starts pushing the envelope down, all right? we're just going to move our whole range down. This up a little bit so the candles are a little bit clearer for you to see. All right. Getting closer to New York. So now you can see this has moved up really to the top of the range here of this New York open, right? Let me get rid of this. That's our daily open. All right, so this is one of those systems of patience, all right, because this is not the kind of thing that you're going to be getting a bunch of trades off every day, right? This is like a one or two trades a day system with a lot of waiting. Okay, so we've hit it into it. That gave you a very nice scalp there. I can just get this thing to chill out for a second now, which I don't think I can. Hit. Gonna take it from that's the closest wick I can get. So, quick 12 points just off of this wick coming back in. All right, but this is not exactly how we're going to play with this thing. All right, so now we've actually broken above this high here. So this is still our high envelope. I didn't change that. I changed this one. But if I need to, I can just move the range back up. All right. Or if price starts kind of looking really bullish, then I would move it to the bottom of the range here, and that would be the trading range for the day. All right. Which is a pretty, it's a decent range. It's big for sure. It is 360 points, which is a pretty big range, but the Nasdaq does do that quite often. Or we could be looking now to just start compacting this because this is New York. Sorry, this is New York is in here, New York Open. We've taken our Asia high, all right, and this is kind of the envelope it's setting up for us here right now. And it really comes into confluence with the trading range if we put it from this point here. All right, so what we could do is grab our envelope, put it at the bottom here. Okay, so now when it comes into this range here, this is when the indicator is kind of important because it's starting to bust down, but you see it already gave you a couple of opportunities here for some quick scalps. And by quick scalps, you're looking at 48 to 84, about 35 points or so there, and probably about 20 points here off of this. But in the in the perfect scenario here, we would hit this bottom and then come up and at least test this zone in here, or come up and test the actual high of the range. That would be ideal. Right? But it doesn't happen. And this starts breaking down. All right. So you can have, there's a couple ways of looking at this, right? We could just keep the initial range that we have, which is going to be that. That would be it. Or you could actually bring this to the downside here. So you could, oh, don't want to do that. You could do something like that, all right? Pretty flexible sort of philosophy with this thing. And because this system has been around since like the 40s, uh, there's a lot of little weird variations that people have come up with, and there's a lot of different ways to use it. But the way that Taylor really did it was he was looking for those market reversals. He definitely thought about the cycle quite a lot, all right?
Hmm.
Did you just say Hansos?
Ah, yeah.
Yeah, yeah, pretty nice. Okay, so it wasn't really the indicator during the day that's catching this move here, right? It is that initial channel that we started looking at, right? The initial trading range, trading zone, right? It's interchangeable. Some people call it the range, some people call it the zone, whatever you want. All right. So there we go. Okay, so that's pretty much it, right? So that was the range with our boxes, our envelopes. Oh man, I did not want to do that. Our envelopes were at the top and the bottom here. All right, so we come into the envelope and price pushes away. All right, and that's a very, very decent trade if you had got in. All right, so we put in a low, a high, a high or low. So she could have got in somewhere off of maybe a breakout of this high, something like that. So let's just take a conservative sort of approach. Quick 56 points. This happened pretty late. Sometimes it'll happen a lot earlier, especially with the New York stop hunts, right? So this is a great tool for finding uh, the deviations that you're going to be experiencing outside of the Asia range if we're sticking in the range, right? But it's pretty wild. All right. So again, it's not like you're going to be using scalping. Uh, I know there are people who use the dynamic indicator throughout the day to kind of hit these little, once it comes into here, you could be looking for short, and once it comes in here, you could be looking for the long, right? I personally don't do that. I just look at it as sort of like a bigger day time frame sort of thing, right? So yeah, it's not the best trade of the day, right? Best trade was right off a New York Open with left that fair value gap. I didn't take that trade, and I stubbornly looked for long all day. But this was your best place to look for a trade here. Right, that was the New York Open fair value gap. Yeah, yeah. But if you had taken the long here, you still would have made off like a bandit with over 50 points. All right. You are very welcome, Bierman. Anytime, buddy. Okay, so it's it's a bit of a wacky indicator, this thing, right? But what I would do is exactly what I was just telling you to do. All right. Hold on, let me get rid of all this stuff. Okay, so at the end of the day, you're going to want to come and mark this out, all right? So, or you can do a replay and then go mark it out if you miss your chance, but mark out the zone. All right, this is the way I do it. Is I mark out the zone and then I mark out the envelopes.
Do you mark it out 11 o'clock when at the hour when it closed?
Yeah, exactly. You got to do it on the close because when it opens, if you're using the indicator, you got to do it on the close. You know, you
Yeah.
got about an hour, or you can, if you get to the chart and the market's already open, then just do your replay back here, and you can get it in there. Or you can be a psycho and do your own calculations, which is actually pretty fun. You so there is a guy that sells a calculator for this for $175, and I've been trying to make my own on. I don't have Windows, but on numbers, right? So basically Excel, and it is quite challenging, I have to say. Too bad I'm not a computer nerd. All right, so yeah, mark out that level, the levels like so, and then mark out your rally point. All right. And then that's it. And then again, once price starts moving, if it really starts dumping, one of the interesting things here, let's say if the market opened, okay, so there's the close. Okay, here's your rally point, right? So for the most part, if the market just starts dumping, that's why you got to be a little bit dynamic with it. You don't just leave the big zone, the big range kicking around here. You move it down, and it see the rally point is right there, right? So it's very close to the bottom, and then if you move the envelope, you're going to find that that zone is inside the envelope. All right. So you don't have to move the envelopes, and if you do move the envelopes, only move one of them, because if you want to quickly bring this back, oh, if you want to quickly move this back because the market then starts pivoting, you can easily bring this back up, put it up to your envelope top, right? And then move this back up as well. So you're not going to be having to shuffle around and go back and figure stuff out anew, all right? Okay, so let's see here if I've got any DMs yet. Nope. Okay. So it's a very heady book. It's very wordy. It's very mathematical. There's a lot of stuff in there, but the way he describes the market cycle is very useful. But it is a very tough read. Like it's probably the toughest trading read I've done. Really, it is the toughest trading read I've done. Like Al Brooks is tough to get through, but I think Taylor takes it up to a whole new level. So again, it's just kind of like get some context under you before you start reading it, because when you start reading, it really is just super heady, especially when you're going through the calculation stuff, right? But it's basically just based on the last 4 candles, right? So it's today's candle and then the previous 3 candles, and you got to do all kinds of calcs. So, for example, that first calculation I showed you, which is subtracting the high from the low, the high from the low, the high from the low, dividing it by 3. Sorry, and then adding the high, and then adding the high, and then adding the high, and then you divide those by 3, and that would be your first support zone. All right, for the envelope. Then you have to do that for the second one. Then you do it for your resistance envelope, and then you do it for your rally point or your pivot point. All right, so yeah, to be clear here, the names on this are not tailor made. All right, this is not. So this would be the pivot line or your pivot number, and then here you have your decline and your buy line, right? But it's basically just a zone. Like you don't think of it as a buying line. All right, like this is not. Sorry, it's the buying underline. That's what it's called in the Taylor. In here, it just called it. She calls it the break cell. And then this is your declining line. Oh no, yeah, okay, that's good. At least one of them is good. So yeah, declining line. This here, for some reason, it's a break cell line, but it's actually called the buying underline. And then it would be the exact same thing for the top here. It would be, pardon me, your rally number. All right, so this is rally number or rally line. Nothing, I don't know why they put break in here, but, and then you have your buying high number. And that would be it. So, and then again, this one is your pivot. All right, the pivot number, the pivot line. So one of the good things about this is that it really does start to make you think about the way the market moves, right? So if you put it into a bit of a higher time frame context, right? He was big on the cycle, all right, and that's a very good way to look at the market, really. Okay, so he did a 3 to 5 day cycle, all right. So that you kind of got to take with a bit of a grain of salt. You have to look at the asset that you're trading, because the Nasdaq is not huge on 3-day cycles, especially when it's bullish. So if you look at any of this, like, so you get 1, 2, and there's a little bit of a drop on the 3rd day, but it still closes higher than the close of the previous day. And then you get this big gap down, a dump, and then, all right, so that almost makes sense. 3 days to the top, and then 2 days down, and then 3 days up, a little bit of consolidation. Really start moving out 3 days up, a little bit of consolidation with a small pullback for 2 days. So when you're looking at market cycles, remember that they are kind of unique to every asset. So figure out what asset likes what, right? So if we look here, once we start going bullish, it's 1, 2, 3, 4, 5, 6, 7, 8, 9 straight days of up, which is not very typical for the Nasdaq, but it does happen. but it is pretty typical to get 6, 7 days of straight movement on the NASDAQ. It doesn't necessarily have to be a 3 or 5 day affair, all right? But oftentimes it is. Okay, so I know that's not overly helpful, but yeah, kind of look at it and try to understand what your asset likes to do, right? If we look at Bitcoin on the daily chart, uh-huh. Okay, so you'll see Bitcoin also becomes a bit of a rager, right? So in terms of the days, don't take the days overly seriously on the market cycle, but definitely try to figure out if there is a pattern to your asset, all right? Whatever it is that you want to see if there is some sort of a pattern, right? And if you can break it down, it'll help you immensely, right? So let's say uh, the trader's reality is really good for bringing the market maker method philosophy, right? So you're basically looking at a weekly cycle, right? Where it would be Monday is just there to kind of screw you over. So let's just check this out here. All right, so there you go. Monday is your false move, designed just to screw people over. It pumps initially and then dumps. So this is your inducement move, which is inducing people to do the wrong thing. Makes a lot of sense here. You've had all these candles up. People are going to be expecting we're going to have a pretty big pullback. Doesn't quite happen, but it does start dropping, right? And then the next day drops and then pumps. All right, but can't break this range. So if we look at this with a bit of a different idea here, all right? Hold on, wrong one. All right, Monday, Tuesday, Wednesday, Thursday, Friday. All right, so there you go. Your fake move. This shows you the real intention Tuesday for the week. And then you get your pullback on Wednesday. And then finally, the real move, right? So this is pure market maker sort of theory, but it looks really ugly, right? But it's textbook. Inducement Monday makes you do the wrong thing. Then you get a reversal. This is showing you what's really going to happen. A lot of people will get excited even if they know the market maker method. They'll be like, yeah, time to pump it. And then on Wednesday, they have the big pullback. And then Thursday, they push it up, right? But this is a 5-day cycle. And on Bitcoin, a lot of guys look for a 3-day cycle. So you'd have 3 days up and 3 days down, right? So there's a big thing in the market maker community, which is the midweek reversal, which basically is, let's say Monday. Yeah, Monday induces down. And then Tuesday, you get the move, the real move. Wednesday, you might get a little pullback, but then it keeps pumping up. And then Thursday, you get like a little bit of a dump and finally turns around in some crazy action. All right. Very ugly because I'm using a very short chart here, but that's the basic idea, right? Monday, inducement. Tuesday shows you the real move. Wednesday, can go either way, but you're eventually going to put in a higher high than Tuesday. And then Wednesday or Thursday, you're going to get your turnaround and come down. All right. Bitcoin is notorious for doing it on Thursdays. On Wednesdays. And the legacy markets, forex markets, are a little more notorious for doing it on Wednesday. All right. So there's a lot of different ways to look at the market cycle. All right. And remember that this book was written in the 40s, right? So in the 40s, it was quite a bit different. It's not like it is today. It's not, let's take a peek here, especially at the NASDAQ. We can't really go back that far.
Yeah. I have to go. Have a nice evening.
Yeah, no worries. So I got to go in 5 minutes too. We'll see if you're around for the New York Open tomorrow, buddy.
Yeah, I'll try that. Okay.
Okay.
Bye.
Ciao, man. Yeah. So if we look here at the market cycle, let's say since the last dump, right? It really is like 1, 2, 3, 4, 5 red candles with the doji candle ending that, and then you get one, and then a little bit of consolidation. Nothing really happens. 2 candles down, 1 up. It starts to kind of show you that there's some indecision in the market and consolidation. And then once we break out of this range, I'm not even going to count this candle. 1, 2, 3, 4, 5, 6 candles up, right? So that's a pretty big cycle up. And then you only get 2 down and then 2 up and then a little consolidation. So keep in mind that anybody that tells you about market cycles, like it's just a very, very general guideline, and not even really a guideline. It's like a way to make you look at how this stuff is going, right? It's almost like Elliott waves, right? It's kind of the same thing. If you're looking at the Elliott waves, you're on a daily time frame. All right, you have a bottom formation here. So here's our bottom. We finally break it. So this would have to be like wave 1, 2, 3, 4, and 5. Something like that, right? So it's just kind of helping you look at it. And that's a horrible Elliott wave count. Quite aware of that, because this is a very nasty 5-wave pullback. This should be a 3-wave, but so it's all, like none of it is perfect, right? But it's just designed to kind of get you to think about what's going on, or not designed. This is how some dudes started seeing it back in the day and started describing what they were seeing. And Taylor was a very good trader. He was a legendary trader, right? So, but again, this is stuff that you got to take it and make it your own, right? You can't, this isn't like a golden pocket sort of thing, or a fair value gap. Even fair value gaps, you kind of got to make them your own, because there's a lot to decipher there. Golden pockets, not so much, but yeah, make it your own. All right. Anybody got questions? Anybody want me to DM you the book? Nobody is writing. Oh, Beerman says yes, please. All right, Beerman, I will zap it on over to you. All right, just take your time with it. Don't. It's just a way to kind of start thinking about the range of the day. All right, and how it's working out. And one interesting thing about it too is that as long as you've got your, if you're, this is what, this indicator calls it the rally line. Okay. It's weird that you got break by. Yeah, pretty weird. So this is supposed to have there's supposed to be actually 7 lines on this, all right? So the 7 levels, for some reason, this doesn't really have the 7 levels, this indicator. But what we can do is I can do the calc on it and I'll put the pivot on it every day, right? But you see how far away this rally line is here, right? So this is your pivot. So if the pivot is below and so far away, then it's kind of a bit of a bullish sign as long as you are not putting in bearish market structure, right? But once you start putting in that bearish market structure, this is where you're going to come down to. That's the kind of thing you're thinking about, right? And it sounds weird because the next day this is going to change, right? And that's really true. So this stuff constantly changes. But if you think about the market cycle and then start adding in other confluences, right? Like, for example, big fair value gap down here, pull a fib, do a volume profile. I mean, that's a pretty nice fair value gap on the daily chart with a golden pocket in it at 19.1 to 19.175-ish, 179. All right, that sort of stuff. So if price does start moving down here and this rally line keeps coming down, and gets into the oh, I knew I had to leave. Hold on, guys, I got to take this 1 second. Sorry about that. Yeah, so it is quite dynamic, right? And this is one of the things that people don't like about this system is that it's not like this very rigid kind of fixed indicator that here's your level on a macro time frame. No, it's a daily thing that changes every day, right? I have seen people do this on the weekly chart, and it also pretty effective, right? But I ain't waiting no. I know that I ain't trading this on the weekly chart on the Nasdaq, maybe on Bitcoin or Nvidia or BHP or something, but I ain't doing that on the Nasdaq. That's for sure. So yeah, a lot of people do not like the fact that they kind of move and they change, right? But the indicator is very dynamic and it's constantly moving throughout the day. But if you take those levels at the close, that's going to be the range for the next day. It'll probably so that's how it kind of works, like the average true range, and then also the envelopes are generally quite useful. All right. So that is going to do it. I don't see any questions coming in. I'm going to Bierman. I'll get you the book. I'll zap it to you. I gotta go out real quick. You're very welcome, my friend. I gotta get out of here. That was my buddy telling me he is here, so I gotta leave. And yeah, that's about it. I got new unreads. Nope, that's lobby. Let's see here in the questions chat. Is this? No, nothing. It's all Norwegian. PC Lounge. Hold on a second. Yeah, that's it. All right, so a bit of a kind of real mellow intro just into kind of the indicator. And then what we'll do on Wednesday is we'll start getting a little deeper into it. We'll start looking at exactly the way that he looked at the market cycle and the way that then we can use that information to help us use the indicator better. Or if you want to do your own calculations, by all means, you don't need the calculator, but we'll get into that on Wednesday, all right? Wednesday evening, ladies and gentlemen. So having said that, thank you for being here. for those of you who show up for New York Open tomorrow, until tomorrow. And if not, see you on Wednesday, guys. Have a great Sunday evening. Crypto Viking, cut the stream.